Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding members of the Dividend Kings marketplace service on Seeking Alpha. And one of the most commonly asked questions we get about FastGraphs are, why are the valuation lines, the multiples, different on the what they call the default graph or our historical graph? Here you see a PE ratio of 13.5 on Southern Company. But then if I go to the forecasting graph and go to the 3 to 5 year trend line, now we're drawing the line with a PE ratio of 15. So the question is, why? Why is that different? So I'm going to produce this video and attempt to clarify and answer that question, but I want to go a little bit beyond that. I want to try to use this time to also help you, especially any FastGraph users, learn how to utilize and interpret the FastGraphs more effectively so that they can help you make smarter and better long-term buy, sell, or hold decisions. Because the first thing is to understand that FAST is an acronym, Fundamentals Analyzer Software Tool. It's a tool utilized to analyze the fundamentals of a business, and by doing that, try to ascertain what the fair value or intrinsic value or proper value that business might be, or where you might be willing to buy, sell, or hold that business. So I'm going to start with Southern Company, which is a slow growth company. And for any company where earnings growth is 5% or less, and I want you to notice from the time frame I'm covering here, 2000 to current, Southern Company's earnings growth was 2.53%. So FastGraphs utilizes two primary and one secondary widely accepted formula for valuing a business. The first is the Graham-Dodd formula, and you can Google that and look it up. But the point is, we mark that by GDF, which stands obviously for Graham-Dodd formula. And here you see that we're drawing the orange valuation reference line. And I want to emphasize, these are valuation reference lines. We're not trying to dictate fair value, we're trying to reveal it. So here we have a line on this graph, an orange line that represents a PE of 13.6, which is obviously 13.55 rounded. Now we also put a second valuation reference on the graph, which is, I guess you could call it a best fit, or what we call the normal PE ratio. And on this time frame, that blue line now is a 15.8 or 15.81 rounded. So anywhere you would be looking at this graph where the price was touching the blue line, it would be around 15.8 times earnings. Anywhere it was touching the orange line, it would be 13.55 times earnings in this example, or 13.6 rounded. Now that's on this time frame on this very graph. When I go to the forecasting graph and the 5-year graph, we've got the growth at 5%. That's the upper limit of where this formula will apply, and at that upper limit, it will typically draw a PE ratio of 15. So what we have here is a different growth rate on this graph, which is utilizing the formula but creating a multiple of 15, versus on this graph where we have a different growth rate. But I also want to show you some other ways that you would utilize this tool. Okay, it's a tool to think with, but it's also a dynamic tool. And now, for example, I will take my scroll bar here and I will scroll out a couple of anomalous years, and now I'm drawing Southern Company with a 3.6% growth rate over the time frame 2002 through current. Okay, and here I'm now applying that 15 PE ratio. Now my normal PE is 16.27. Now, both of these numbers are within reason of what we saw just a second ago, but they are different. But the key is to look at the graph, look at the line and how it relates to the price, or look at both lines and how they relate to the price. And what I'm going to argue here is you see a very high correlation of what the market wants to value Southern Company at somewhere between 15 and 16 times earnings. Occasionally it gets a little higher, but for the majority of the time frame here, or for the very high correlation, somewhere between these two numbers makes a, what I would call a rational assessment of fair value if you were going to buy Southern Company. But keep in mind, a rational assessment of fair value doesn't necessarily mean you're going to make a great deal of money. For example, if I also use my scroll bar here and kind of come into some periods of time where I can get closer to where the stock is trading at fair value ranges, I've got 2002 to 2018. The price is more or less on the 15 PE and more or less on the 15 PE here. We have a 3.8% growth rate. Notice that the growth rate is changing and the multiples that we're drawing these lines with are changing. And so the key is, if you're going to utilize this tool correctly, every time you change anything, make sure you look here to know what you're looking at. So I've got a 15 PE, a 16.1 PE, and as I look at this, the key point is this: I've got 3.83% growth. I also have the dividends, which is this light green shaded area on top that is, represented by the area down here that was paid out to you as a shareholder. So the point is, I know that I'm going to get growth somewhere around 3.8%-ish. Might be a little higher, a little lower, depending on exactly what these starting PEs are and what this finishing PE is. But I'm also going to get some income. So if I look at performance, I've got my 3.3%, just as I expected, plus I have dividend income, so I'm averaging 6.6% owning Southern Company over this time frame, which would have been from the beginning of 2002 to the end of 2018 in this particular time frame I'm drawing. But the key is, I'm using this tool and I'm evaluating what I see here. I see a 15 and a 16 PE, and I see a stock that wants to trade in that. So I know it would be a disadvantage to me to pay a higher multiple to buy Southern Company. It eventually reverts to the mean, and my rate of return now drops down to 3.5%. It would be more advantageous to be able to buy it when I could buy it below the line. That would run my rate of return up to 8 or 9%, and I even did a little low there. So the point is, you need to be evaluating what you're looking at. And I'm looking at numbers here under 5%, so I'm using the Graham-Dodd formula. When I go to the forecasting graph, I'm using the 3 to 5-year trend line. They're forecasting 5%, which is the upper limits. Now I'm drawing a 15 PE. Okay, but I also have these other PEs. I can look at a 16-ish PE or a 13-ish PE like we saw in the beginning of the graph and run what-if scenarios based on calculations of what my future returns might be given these various multiples. So I'm using it to think with. All right, now for what I'm going to do from here, I'm going to change now, and I'm going to move on, and I'm going to go to a faster growing stock, Ross Stores. I'm going to look at this stock historically, and let me expand this out first. Now in this example, I'm using our second primary formula, which is the formula made famous by Peter Lynch, which is the PE ratio equal to growth rate is fair value for fast growing companies. This formula will automatically be applied when growth is above 15%. Here you see the growth for this time frame is 16.19, so we're drawing this orange line on a rounded 6.2 PE ratio, and we've got the blue line here of an 18 PE. Now as I look at this, if I kind of even glance back historically, it becomes obvious that if I take this line back, I'm going to get a different factor. I'm getting growth now of 16.96%, and I'm using the P equals growth, so my orange line is 16.9, and ironically, I've got a conversion of the normal PE here, so what I'm really saying is around 17 times earnings from the period 2000 to 2015 was what I would call the rational or most common application of fair value or iteration of fair value of about 17 times earnings. You can see the stock trades at that, quite consistently, but the point is I've got a different growth rate here. If I change this time frame again and go back further in time, now I've got a 17.05% growth rate, and I'm drawing these valuation reference lines at 17 and 16.1. Notice the blue line now came slightly below the orange line. All that means is the mathematics are dictating that, but I'm applying the formula and I'm analyzing now whether those formula applies. Would have helped me make decisions back here, and by looking at this time frame, had I been living in this time frame, I would say a 16 or 17 times earnings multiple is attractive, and if I could buy it at less than that, for example, if I could buy it at a 14 PE or buy it at a 12 or 13 PE, I'm going to make a prudent and very attractive decision, ceteris paribus, all things being equal. But as I move down the line here, notice the growth rate's changing. Now all of a sudden the growth rate's 18%, so any of these cheaper prices I would have paid would have even rewarded me more because I've got more growth going forward. But I can use this tool in all these iterations to come up and analyze different periods of history, for example, when I'm doing the historical graphs here, and determine what is. Now all of a sudden I've got a period 2008 through January of 19. This has a January fiscal year. That's why I'm including 2019. This is mostly 2018. 18, all of a sudden I've got a 21% growth rate, and I can see that I've had a little bit higher multiples here in general. My normal PE is below the orange line again. It's around 18, because back here as we went through that, we had much lower multiples coming out of the recession, and then here we had some periods of higher multiples. But my point is, ladies and gentlemen, I'm analyzing this. I'm evaluating this data as I look at it. I'm not letting it tell me what valuation is or dictate to me what valuation is. I'm letting it reveal valuation, and then I'm making decisions. But now when I go to the forecasting calculator for the next 3 to 5 years on Ross stores, the analysts are forecasting 10% growth, which is significantly different than these historical numbers. And so now if I'm going to make a rational decision about the future, I want to be making that decision based on what the future is going to hold. And now, because I've got a 10% growth, I'm using my third formula, which is really an extrapolation between the Graham-Dodd formula and Peter Lynch's P equals growth rate formula. And this will apply a 15 multiple, which is a very common multiple for common stocks, as I've discussed many times on most companies. But I'm going to elaborate on that a little more. But the point is, the reason the multiples are different here is because I'm dealing with a different dynamic. I've got different growth expectations here than what I've actually accomplished here. And when I'm including estimate data, keep in mind, some of that estimate data is going to be included in this calculation of growth, runs from this point to this point. So it's the mathematics are determining what multiples go on the graphs. Now, if I go a little further down, since I just introduced the Graham-Dodd formula, P equals growth rate extrapolated formula, let's move on to Johnson & Johnson, and let's look at it from the standpoint of the formula. Because the growth rate is above 5, it's 8.99% over this particular time frame, and I'm using a normal PE of 18.41 because I've got some high PEs here, some low PEs here. So this isn't a great fit, but it is the best fit over this time frame. But I'm now utilizing that 15 PE. But watch what happens if I shorten this and come up into more, recent times where I'm looking at 2006 through 2010. All of a sudden now I've got a 15-ish PE ratio, both of my normal and my orange. And again, the numbers are marked here. So I've got a 15 and I'll call it a 16 PE on this graph. And I'm looking at these pictures and I'm seeing that there was a period of time when Johnson & Johnson traded lower, a period of time higher. Obviously, from a prudence point of view, I'd love to be able to get a chance to buy Johnson & Johnson. It was lower, but I've got a good guideline here. I know that somewhere around 15 or 16 times earnings makes sense for this company. When I go to the forecasting graph, I'm looking at a lower rate of growth expectation of about 6%, 5.9, but that still gives me a 15 PE. So my forecasting graph is going to be drawn utilizing that number. So the three formulas are Graham-Dodd formula for low growth, P equals growth rate for higher growth, and then an extrapolation in between. But the point is that doesn't mean that Fastgraphs is saying that this stock is worth that. It's drawing the graph and giving you the opportunity to utilize this information to make a better decision. If I look at Google here, now referred to as Alphabet, I see 37% historical growth, so I'm drawing the PE ratio at 37. Here I'm drawing it at a blue line. Now, as I look at this graph, the 37 doesn't make a lot of sense. And even the 31, the normal PE of 31 doesn't make a lot of sense. So the first thing I might want to do is I'm just going to take my tool and get rid of some of these high numbers here and see what happens to the graph. Now, all of a sudden here, I've got growth of 15% and got these valuation reference lines, and they aren't really helping me that much. So I'm going to try to, move this around. Now, all of a sudden, I'm seeing, somewhere between 20 and 25 times earnings since 07 through 018 was a pretty good valuation reference line. Now, one of the keys is I never want to overpay. That's really the key here. So even though I may see numbers that justify, a higher multiple, I don't know that I really want to pay that because I don't want to take that extra risk. But I'm using this tool to help me make decisions. I'm not using this tool to dictate the decisions to me. If I look at a stock like Cognizant, very interesting. I'll end the tutorial with this. If I look here, I've got a PE ratio of 26.8 because that's the growth rate for this time frame, which includes estimate data. And I've got a normal PE of 30. Now, if I'm looking at this graph, those valuation references worked pretty well, going back from, let's say, 2011, maybe even 2012 backwards. Those were pretty good valuation reference lines. But if I go forward, they aren't very good. So if I, run my scrolling bar again and move up to more modern times, all of a sudden I start seeing that my growth rate has changed to 12%. So I'm using the extrapolated formula. And what I'm finding here is that I get, different fits by moving the graph around. So I'm starting to look at a 17 to a 20, we'll call it, PE ratio normalcy over the time frame 2009 to 2018. But now when I go into forecasting, I'm looking at a company that's expected to grow at 10% per year. And so now I'm back to my 15 PE, which is being revealed, if you will, on the fast graph. And I'm going to use that to make my judgments. And I think that's a very conservative number in this case, so I might want to really focus on that. But the point is the reason these lines are different is because of the dynamics of the different growth rates over all these different time frames. And what we're trying to do is draw graphs here that help you make better decisions. And I'll end with an exception. If I looked at a company like Ecolabs, for example, and I do this often with subscribers, and I look at how the market has valued this stock, in spite of the formulas that were being applied, the market has typically applied somewhere around a 25 to 30 multiple, 27 on this time frame. So even when I change these time frames here, this has been a very consistent company where that multiple stays between that 25, 28 range. So the point is, I see this, I understand it, I don't argue with it, I recognize that that's how the market wants to value this stock, and that's even with an 11% growth. So if I go to forecasting here and I look at 12% growth, I'm going to say that 20-something PE multiple, that normal multiple, and I can use my graph here to come up with what a normal multiple is, and it's somewhere again around 25, 27, 26. I've got these numbers here, so I can pick one, apply it to the graph, and if I wanted to, I could go into my additional settings here, by the way, and here I've got 26.7, so I'm going to draw that simply as a 26 PE, even though I'm rounding it down. I'm going to apply the setting to this graph, okay? And now, as I'm looking at these graphs, close this, when I go to my historical graph, I'm going to add that additional line. I've got a 26 PE ratio line now written on the graph. It's just another valuation reference, and I'm, close there. But now when I go to my forecasting graph and go to my 3 to 5 year graph, I now have the normal multiple. I can run my calculations on that only based on the historical evidence. But from my point of view, reality says it should be trading down here, but the market says it should be trading up here. I'm not arguing with it. I'm looking at what the graphics is revealing to me and then trying to utilize that to make decent decisions. Anyway, Fast Graphs is a dynamic, powerful tool. It's based on the mathematics, and the mathematics are dynamic. If you change time frames from, just as simply as up here, when you change time frames, the growth rates are going to change. As those growth rates change, the valuation reference lines are going to be drawn slightly different. But the point is, you need to recognize that you're dealing with a dynamic tool, and it's trying to give you some guidance on how you can make better buy, sell, hold decisions. Anyway, this has been Chuck Carnevale saying thanks for watching. If you liked what you saw here, go ahead and subscribe to our YouTube channel. I think you'll find a lot of videos on there that might help you make better decisions on individual stocks, and also if you're a user of Fast Graphs, make better decisions on how to utilize the tool. Thanks for watching, and look forward to talking with you again real soon.